Good afternoon, everyone. Allison Scoberg here with Consolidated Planning Group. We are also here with CPA Shelli Dodson and Mike Levinston. I said it wrong. I want to get that right. And Blake Hutchinson with the Misty Carroll Project. So we're going to hear from each of those today. I want to start out with a few housekeeping items. First of all, if you are here for the first time joining our webinar, welcome. We are certainly glad that you are here. Consolidated Planning Group puts out webinars every single week on topics about planning for special needs. We have our Consolidated Planning Group YouTube channel where there are 500 webinars on planning for special needs organized in a pretty organized fashion. So you can kind of search the topic for the journey and the step that you're on in the planning process. And there's probably a webinar on that topic. As you guys know, as parents and professionals, that serve the disability community, all of the topics that we talk about are convoluted. It's always a lot. It's a lot of information, and a lot of times we have webinars a whole hour on a specific topic. So today we're going to be talking about tax concerns for special needs. We've had some webinars on this in the past, and we got a lot of write-in questions. So thank you for sending your write-in questions today. We're going to get to as many questions as we can during the time that we have together. And if we don't get to yours today, then we will get back with you on that. We do invite you to put your questions in the chat box. And I'll be monitoring the chat box today for Shelli as we're going through the presentation. So another thing, we are in webinar mode, which means that we can't see or hear you, but we know you're out here and we're glad that you're here today and that you have joined us. Consolidated Planning.
Allison, I think we lost your mic.
You did, thank you. We are members of the Special Needs Planning Academy, nationally certified as Social Security advisors. Our whole firm is nuanced in planning for special needs. People come to us because they want to plan for the future of their loved one with a disability. They want to know things like how and when should we apply for public benefits? How do we maintain those benefits? How do we have money in the right buckets to maintain those benefits? How much money do we need to fund a special needs trust? Who's going to care for my child when I'm gone? Those are all things that we work with families on as we're going through the planning process. We put protection plans in place for families, lifetime care plans. We do a lot of transition planning. We help set up ABLE accounts, and we do a lot of advocacy. One of the things that we always share with families is that when it comes to planning for your loved one with a disability, your situation is specialized, and it is truly important that you have the right people on the team when it comes to planning. And whether that is a CPA that is nuanced with special needs and has an understanding of taxation matters as it relates to special needs trust, whether that's an estate planning attorney who is nuanced in special needs and has the knowledge that they need to set up a special needs trust properly, or take down the guardianship path and what the alternatives to guardianship are if that might not be a fit for you. And when it comes to planning finances, a special needs financial planner, those are all people that you're going to want to have a seat at the table. So whether you work with us or you work with Shelli or you work with a specific attorney, it doesn't matter. What matters is that you're working with a professional that truly understands special needs. So we've got a lot of things to talk about today. So right now, what I'm going to do is I'm going to turn it over to Mike, and he's talked to us about the Misty Carroll Project. We've partnered with them today for this webinar. So Mike, please tell us about the Misty Carroll Project.
All right, thank you, Allison. Thanks so much for having us. Yeah, the Misty Carroll Project is something I started in the name of my sister a little while back. We're relatively new. I got to say, when I started it was like running through the woods blind. So not knowing much about what to do on this side of our family. My sister was born with Down syndrome and passed. My father was returned from Vietnam. A lot of the boys that came back from Vietnam were exposed to Agent Orange, a lot of other things. A lot of them had special needs children when they came back. So when he returned, Misty Carroll was born. She had Down syndrome, heart issues right out the gate. She passed at the age of 3, right about a year before I was born. So this has been something that's been in our heart and in our family for a long time. Uh, Actually, I had never met my sister, but I had a dream one night about her, and the nonprofit is something I'd been thinking about for a while. And all she said in this dream was, "Little brother, it's time to go to work." So that's kind of what kicked this whole thing off. Long story short, the Mystic Coral Project kind of fell in line. It was kind of a God thing as it just slapped me in the face, side to side, things fell in play. The whole point of what we're trying to do is to try to reduce the frustration for families by becoming a true point of reference for families to learn about the benefits that are out there, the resources and tools that are available to them, then how to navigate them. And at the same time, we want to empower those families through just creating a community and building a stronger community within themselves. I talk to a lot of families, they really feel like they are alone, and that's really difficult. We want to be able to connect those families in a way where they can share their successes, their downfalls, and just build this educational strength for them where they can rely on each other and learn in one place because nobody knows where to start. And when they do learn to start, everything changes all the time. As we go through, Shelly will talk about that a lot today. There's a lot of things that just change consistently. There's a lot of things people just don't even know where to go. So we want to start to create that, and along with we found a consolidated planning group. That was a great place to start to build a library. Ultimately, we want the Mystic Carol Project to be a resource for families and a place to go. And especially in our small community, there's not much for families in this area. And I see that in a lot of small communities where we don't really have a rehab center. We don't have areas for families to go. So we want to start to create that. And in time, ultimately, we'd like to, start a learning center and a day hab center for families. And in the meantime, we want to be able to build that community purpose around here through different events and things like this, webinars, and educating them through a library of resources that they can go to. Hey, I don't know what to do for this grant, or what do we need here and there. So those are the things we really want to start to develop as the Mystic Carol Project, especially in our community and in communities like ours all over. So with that, this is where we start. We really appreciate the opportunity to get the word out and say who we are and what we do. And Consolidated Planning Group's going to help us do that. And we're really looking forward to Shelly's presentation today. And I hope that this will help some families learn some things and answer some of the questions they're going to have.
Just real quick, Mike, and thank you for sharing that. We're excited of what you're doing. And your contact information on how families can engage with you. Could you give us an example of why specifically? Give me kind of an example. Someone comes to you and the services that you might provide to them.
Different things we'll do, like especially if there's families that can't really afford different services, we can always point them in directions of people that will help supply them in, like, say if they need a parent advocate for the school, we have a network of that. If we have people that can help with trust, with if they're trying to learn more information or just get some actual advice on different topics. Really, we have built a network of people all over that will help guide them. And then if there's something that comes along that they can't afford, we're going to try to fundraise. We're going to try to supply different financial resources on those ends. We're going to do fundraising events on, especially like trying to put together trusts, things along those lines. As we build, we really want to try to help, especially the people in our area that struggle as much as we do in a small community, to try to afford some of the services that a lot of families really they don't have the money for. And it's even harder when you don't have the money to do something to get the help that you need, because some of these programs, they aren't cheap to go out. You can't afford to go get a professional day hab, or if you have to work all day, how do you have somebody drive your special needs individual around, or how do you get transport? Those are things we're trying to solve in our community.
Well, thank you for the work that you guys are doing. It's a big deal, and we're so grateful for that. So thank you for being here with us today. And we're going to get started kind of talking regarding tax matters as it relates to special need trust. And we've got Shelli Dodson here. She is a CPA and also a parent. to an individual with a disability. And so she eats, sleeps, and breathes this like me, both personally and professionally. So we're grateful, Shelli, that you've joined today, and we're excited to hear from you. And because we have so many questions today, we've got a lot of good information in the slides. We want to get through the slides today. We are watching the chat box, and you can put your questions in the chat box. Our slides are going to answer some of the questions. So we're going to take a little bit different format today. So, but do put your questions in there. We'll get to them in just as soon as possible. Okay. Thanks, Shelli.
Thanks, Allison. Thank you for having me. Like Allison said, I'm a mom of a special needs child. He's 12 years old, and I am continuing to go forward in my journey with trying to figure out what is out there. So as a mom of a special needs child, I realized that some of the resources they just seem like we can't find them. And so it was important for me to be here today to present myself as a resource to give you guys some understanding of the different tax implications and what can happen with our special needs children. And I may not know every answer today. If anyone that does is, I think, not honest with themselves, but I can help find the answers that we don't know right off the top of our heads. So with that, let's just kind of dig in and kind of give you guys just a general overview. Of course, I am not an attorney. I'm not pretending to be an attorney. So some of the questions we might need to seek attorney advice for that. But a lot of this will cover the majority of the questions that you have. And then like Allison said, we're definitely going to try to get to those individual questions that we can answer in this forum. So with that said, let's talk about the two types of special needs trusts that exist for our kiddos. One of them is going to be called your first party special needs trust, and the other one is your third party special needs trust. That first party special needs trust is going to be funded by funds that belong to the child themselves. So child support, their social security, their personal savings, lawsuit settlements are the big ones. A third party special needs trust is going to be funded by someone other than that child. So me, when I die, I will probably fund a special needs trust for my kiddo. My mom might put some money into a special needs trust, money that doesn't belong to the child themselves. That's a gift or inheritance from a loved one. It's important to understand that the beneficiary, for being able to still be eligible for a lot of the benefits that are out there, in most cases, the beneficiary can't be in control of these assets. And that's why we have trustees that come in and kind of administer these trusts. A first party special needs trust does have a Medicaid payback. So when they pass, if there are funds in there, there is a possibility that Medicaid can come in and grab some of those funds back for different reasons. If it's a third party special needs trust, the Medicaid payback provision doesn't exist. And so that's important to understand. Both of these trusts can be used to help the child in getting additional out-of-pocket expenses paid for without really impacting their benefits on a different level. So the trustee is the one that's going to manage. So most times when I run into special needs trusts, it's the parents that are the trustees. And as trustees, we have a fiduciary duty to the trust to make sure that we are carrying out the provisions of the trust. And those provisions are determined by the attorneys that help write the trust documents. Let's see. The flexibility of, so the funds, again, the funds in the trust are there to be in support of the child. So there's a lot of things that we can do with these funds. We can do additional out-of-pocket, we can do recreation. We'll look at these in a couple of the additional slides. Let's see. Allison, can you advance this slide? Give me a second, you guys, we're having just a little bit of. Okay. Let me.
Okay, it went down. I'm going to bring it back up. Sorry about that. Little slide difficulty. It has been a technology drama today. Sometimes that happens. Okay, can you see that now?
Yes.
Okay, perfect. I
Okay.
just also wanted to mention too, that there is some proposed legislation to get rid of the first party Medicaid payback. And then some people say, I heard that they got rid of it. It hasn't passed yet. It is proposed, but it has not passed as far as getting rid of that Medicaid payback. So I just wanted to mention that.
Perfect. And I do see in the chat that we asked about revocable or irrevocable. So let me hit on that for just a moment. A revocable trust is one that we can change during the grantor can change. So the revocable trust, the grantor puts their money in, that can be, and the trust can be changed at any time. An irrevocable trust, for all intents and purposes, once it's set in place, you cannot change that. So, that's the difference between the two. I see the special needs, the first party special needs trust, because it's a grantor trust, it's usually revocable. The first party special needs trust, the benefit to that is the trust exists, but what I call it is kind of disregarded for IRS purposes, because the income of that trust, the money that is generated off the corpus or the principal that's put into that trust, is taxed to the individual or the grantor of that trust, so the child. And the trust is going to pay extremely higher taxes than an individual. So that is one of the benefits of the first party special needs trust, is that you're going to get lower taxes on the income that's generated by the principal. On the third party special needs trust, if it's a grantor trust, again, it's going to be taxed to the grantor of the trust. If it's a third party non-grantor trust, then that trust exists as a separate entity distinguished from the beneficiary, and it has its own individual tax form filing. It must file that tax return every year, just like we do as individuals, and it has to account for the income and expenses that go through the trust. The third party.
Can we talk about that revocable versus irrevocable? Because what I have seen, we work with attorneys all across the state, and some make theirs, irrevocable, some make them revocable, and I think it depends on the attorney that you're working with, and it depends on what your needs are. There's not necessarily a right or wrong way, but when you set up a third party special needs trust, like say for instance, my parents are intending on leaving an inheritance to a third party special needs trust for the benefit of one of my children. My parents, because they are the gifters, right? They might want it to be irrevocable, so it could not be changed, later. So that may be a reason. So we've seen people that are giving sums of money want it, to be revocable as opposed to revocable, but I don't know that there's a right or wrong way. And again, different attorneys do it different ways, and I think that's okay.
I completely agree. And when it comes to the trust document itself, I actually prefer, when I get a client and I receive that trust document, I like to reach out and talk to the attorney that drafted the trust document, because there is not a template out there that you can read that 100% defines the trust, in my opinion, as a CPA. I always reach out to the attorney and say, what did you mean this to be? Did you mean to, there is actually a type of trust called a intentionally defective grantor trust. So I always reach out to the attorneys to see what their intention was. And then of course we note the file so that we know how to prepare the return moving forward. So working with the attorney that is just engrossed in special needs terms and what those means, that's definitely a must. The attorney is going to be your foundation for everything. So when we let's look at income, because income for tax purposes and income for benefits purposes, those really are separate and distinct. Income tax purposes, that's going to be pretty straightforward because we all have income tax. So taxable income for tax purposes, if your special needs child is working and they're getting a W-2 from a job, that's going to be taxable income to them. They may have dividends, interest from investments. The same thing that you and I have as taxable income as mom and dad, the child is going to have as taxable income. Now, some of the income that they're receiving may be exempt from taxation. And so it depends. We have to look and see what kind of income that they're receiving. For example, my son is receiving childhood Social Security. So while he's receiving that from Social Security each month, that in and of itself isn't taxable. It could potentially be taxable if he had other things on top of it, but by itself, it's not. So we kind of have to look at the sources of income that the child is receiving, and then we have to kind of lump them all together to determine the ultimate taxability. Children today, single taxpayers for right now, for 2025, the standard deduction for our single taxpayers is $15,000. So until we reach $15,000 in income, you don't technically have to file a tax return for those children. Different schools of thought exist. Some people say go ahead and file a tax return, even though it's not required, just to get into the system. Other people say if I don't have to file, I'm not going to file. So we have some decisions to make if our kiddos are getting to that mark where we need to file. So for purposes, income for purposes of SSI, that's going to be a little bit different. Earned income is going to count for us. Unearned income is also going to count. So Social Security, state disability payments, unemployment benefits, interest, dividend, those are going to count for SSI purposes as well. For SSI, the one, like if I could highlight anything on this screen that as a mom, I was like, what are you talking about? It's the in-kind stuff that really can reach in and kind of grab us. So if your child is receiving gifts of gift cards, cash, when we later on direct distributions from a special needs trust, those things can also be counted as income for benefit or for Social Security purposes. So we need to really keep an idea of what's going on with that and keep tabs on it. The other thing that
This is true on Zelle too, because a lot of our kids, like your kids, like, can I have some money or whatever, and we Zelle them money and it kind of goes in their account. And this can also be true for like checks for birthday, or they got a whole bunch of checks for graduation or other things like that. So it's better to have that kind of money, those checks to go into an ABLE account as opposed to directly into their account where the SSI goes. And I just want to mention how important it is to understand of what's counted for SSI and what's counted for SSDI or childhood disability benefits, DAC benefits, Social Security, totally different. So they're two different programs. The Supplemental Security Income Program for the disabled and the indigent is basically going to count all things. A lot fewer things are counted, and you're talking about the Social Security Disability Program. So it's important to understand the differences on that.
And I know that we talked about kind of putting off a question until the end, but this question, and Allison and I actually talked about, and so I want to hit it now because I think a lot of you guys have this question and it completely makes sense. One of the things that got me, look, I'm planning on my child living with me for a long time. And so when I was originally doing all this research and they were like, in kind is going to be rental income, I was like, what? Like, are you kidding me? So Alice and I were having this discussion this morning about if your child pays you rent in order to keep their Social Security benefits, is that taxable to you or is it not? And I'll be honest, and Allison said it, you can ask 5 different CPAs and you're probably going to get 5 different answers. Here's my take on it. Yours you need to talk to somebody, but if you are charging your child true fair market value rent, like, and probably none of us are, then I would say, yes, it is taxable income to you. Fair market value would be taxable income. However, if you're charging less than fair market value, then I'm going to call that in my book kind of like a cost share situation. And I'm not going to put that on my tax return as income because I'm not charging him rent. He or she is simply just reimbursing me for their share of the household cost. And so I think that kind of answers a lot of questions for people that were in the chat. Another one, just to back up, 15,000 income is for the 2025 tax year. For 2024, the standard deduction was 14,600. So it went up just slightly for 2025. One thing that I personally am keeping my ear to the ground on, and I'm sure Allison's team is too, and with an election that just happened, a lot of the things are up in the air. The provision for the expanded standard deduction of 15,000 for a single person, 30,000 for a married person, all of that is supposed to sunset at the end of 2025. This is a pivotal year. We don't know what will happen with the new administration in office. So I would suggest we all kind of need to be ear to the ground on that, but definitely your tax person will have their ear to the ground because it will impact so many of our regular clients in addition to our special needs kiddos. Sorry for a little sidebar there. So what is not considered income for SSI and SSDI? Medical expenses that you pay out of pocket, temporary assistance, SNAP benefits, and then again, some certain government benefits aren't going to count for SSI purposes. Let's see. Okay, so when it comes to filing taxes for your third-party special needs trust, for an irrevocable special needs trust, remember those are the ones that the IRS sees them as a separate and distinct entity. They have their own tax ID number. They're going to file a Form 1041, and they are going to need to file that form if they receive more than $600 in income in a calendar year. That's not money going into the trust per se, because money going into the trust is considered corpus, or and some people call it principal. It's the income generated off of the corpus or the principal sitting in the trust. So if you happen to have enough money sitting in the trust that you generate more than $600 worth of income, then a tax return is required. The trust is going to file tax form 1041. And if the trust is termed a qualified disability trust, then the trust, instead of getting a $300 deduction, kind of like a standard deduction for people, it's going to get a $5,000 deduction, meaning that the trust itself can have $5,000 worth of income before it's going to be subject to any kind of income tax. So the requirement for a special needs trust is, again, this is today. This might change tomorrow. Like Allison talked about at the beginning, we've already had Social Security change some of their ideas on food. The beneficiary must be under 65 and have a disability defined by Social Security Administration. It needs to be funded with the assets of the beneficiary. It needs to be managed by a trustee who has discretion and control over how the trust uses those assets. It cannot distribute funds directly to the beneficiary in a way that would make them ineligible for needs-based assistance. It's set up to supplement, not replace, the government benefits that the child is receiving. It can pay for non-essential things like education, recreation, travel. I've got a list on some of the subsequent slides of different things. Must be irrevocable, so it can't be changed. And the assets in that trust do not count towards the beneficiary's resource limits for government programs. So this, just so you guys can see it, this is just a sample of a 1041. This actually is, if you look at the box on here, we have it checked as a qualified disability trust. And you can see down below that the exemption is that 5,000 that I talked about. That little box, as small as it may seem, checking that box is what's going to make the trust eligible for the $5,000 exemption. If this is simply a complex trust, which means that the trustee has the right to disperse or not disperse, then your exemption is only $300. And so that can make a big change. And on the next slide, let's talk about the tax rates. Um, my husband and I were having this conversation this weekend, and he said, guys, I'm going to leave the house to my normal son. I'm going to leave my 401k to our special needs son. And I was like, hold the bar. No, we're not. Um, I said, because you may have more money in your 401k, but when I put that inside of a trust and have to pay income tax on it, that might really kill the deal. Because tax rates for trusts, you guys, it's just exponentially higher than what an individual pays on that same amount of income. So this slide, and I won't go through it because you can look at it, but these tax brackets are crazy. An individual is going to pay 12% on the first like $40,000, whereas a trust, once it gets over $2,700 in taxable income, it's already in the 24% bracket. Now, if you're like me, I'm a much more visual person. This chart's great, but show me some real numbers. So on the next slide, I put together a side-by-side representation of the trust. So you'll see the trust on the left. This is a 1041 prepared for $50,000 worth of interest income. So if a trust earns $50,000 worth of interest income, and we take an exemption of $5,000, the taxable income is $45,000. The tax on that inside of a trust is $15,000. You take the same $50,000 in interest on the right-hand side, with just a normal 1040 single, you subtract off for 2024 the standard deduction, and you get 35,400 of taxable income. The tax on that is $4,000. That's 3 times the tax if it's in the trust than if it's on a 1040. So in the beginning, when I was talking about the first party special needs trust and that not being such a bad deal for the tax of it, this is what I'm talking about. A child can have $50,000 worth of interest income and only pay $4,000, whereas a trust would pay $15,000. So that's kind of just an example of the difference between the two types of returns and the tax rates for each one of those. So deductions, things that the trust can deduct that your child cannot, fiduciary fees. So if you're using somebody specially to help kind of manage the assets of the trust, that's going to be a fiduciary type relationship. You're going to have attorney's fees. If you're meeting with your attorney to make sure that everything is still updated, if you're calling your attorney, asking them questions about the trust, and he's answering questions about the trust, accounting fees to prepare the trust tax return, and then trustee fees for administering the trust. Most of us as parents don't charge fees, but if you have a corporate trustee, they're going to charge fees. All of those are deductible at the 1041 level. These things would not be deductible on the 1040 level. So that is just a nuance between the two. The trust can deduct these things, whereas the individual person cannot. Let's see. On the next slide. Okay. So let's talk about how to get money out of the special needs trust, because that really is, now we've got the special needs trust, we've put all this money into the special needs trust, but it doesn't do our kiddos any good sitting in the special needs trust. So to get that money out of the special needs trust, we really need to be aware of how we get that out. So carrying out the income, moving the money from the trust to the child is the most efficient way, because as we saw, the trust, if the trust retains all of that income, it's going to have to pay a lot more taxes than if we move some of that income out to the child. But we have to be careful. So what you don't want to do is you don't want to, from the trust account, send your child $1,000 directly. That's not how we want to get that money out of there. We want to get the money out of there by sending it to the caretakers for our children, or sending it directly to what we want them to do. So for example, if you're paying the doctor's office, we want to send it directly to the doctor's office, not to the child and then to the doctor. So you want to be very careful about the flow of the paper, right? If you guys are paying for vacation, you want to pay it directly to whoever we're going on vacation with, not to the child. You guys, I can't stress enough, paying it to the child is definitely not going to be the best way to do that, because that's going to impact your benefits that we're working so hard to keep intact. So here's kind of a list. It's not all inclusive. It may seem a little over zealous, if you will, but kind of an idea of what the trust can pay for. Accounting, obviously, we talked about, but if the kiddo needs a microwave, if you have a camera, my child doesn't, but he uses my cell phone. I think I delete 200 pictures a day of things that he takes. If they need a phone, you can pay for a phone. Clubs, sports dues, computers, dry cleaning, elective surgeries, eyeglasses, fitness equipment. And so I think we have like three slides of just general things that the trust can pay for.
Kelly, I just wanted to mention, because a lot of times a question that comes up all the time is, why do I need an ABLE account and why do I need a special needs trust? And ABLE account is under the tax code 529A for achieving a better life for an individual with a disability. Money in the ABLE account, as long as there's less than $100,000 in the ABLE account, won't count against them for SSI or Medicaid purposes. And basically, an ABLE account can pay for shelter without a 1/3 reduction to SSI, whereas a special needs trust can pay for a shelter, but there would be a 1/3 reduction to SSI. In example, if they're not getting SSI, then it may not matter. You can have an unlimited amount of money in a special needs trust where there is a limited amount of money that you can put into an ABLE account each year, which I think you have a slide that's going to talk about that. But there is a limited amount of money that can go into an ABLE account. And then again, it's capped. You can't have more than 100,000 before a person's going to lose SSI. They'll be able to keep Medicaid, but they would lose SSI. So an ABLE account and a special needs trust actually work beautifully together. And then final thing that I wanted to mention on this, because some people think, well, I can't really afford to set a special needs trust right now, so I'm just gonna have an ABLE account. We can't leave money to an ABLE account. There's like, how like we could leave a beneficiary. So we could make a beneficiary a special needs trust for a said individual, and that special needs trust could make a distribution to the ABLE account, but we can't leave money to an ABLE account. So that, and again, if we did money to an ABLE account, it would probably be far greater than the annual amount that you could, or far greater than the total amount. So that's why that doesn't work. It's both, not one or the other. So I always just want to mention that because it's true that in an ABLE account, you can pay for similar expenses that you can pay for in a special needs trust. But the key factor is that you can pay for food shelter out an ABLE account without a 1/3 reduction to SSI. And they did get rid of the food thing, but they have not gotten rid of the shelter thing. So that's a big deal.
Yeah, I agree. And I think you guys, we're talking about trust, and thank goodness we're gonna talk about the 529 ABLE accounts. I mean, as I sit here and I'm kind of in the same boat with you guys, I'm still going through my planning and what makes the most sense for me, what makes the most sense for my family and my child. The ABLE account is very attractive. I'm not gonna lie. There's a lot of things that make the ABLE account attractive over a trust at this point. But I think at some point we're gonna have to bring those together. And so that's why sitting down and talking with someone like Allison and someone like myself, and maybe both of us at the same time, and just having a brainstorm of things and bringing the attorney into it, it makes the most sense for everybody. We've got a couple of questions that make sense to answer right here. Let me pull those up. Let's see. So a qualified special needs trust can be funded by the beneficiary, the child's money, or someone else's money. It's the qualified special needs trust. It's the first party that can only be set up with the child's money. It's the third party that comes from other people, but both a first and a third party special needs trust for IRS purposes can be a qualified disability trust that is eligible for that $5,000 exemption. And then someone asked if child support into a first party special needs trust is considered taxable income to the trust. It is not. So that is not considered income to the trust. Let's see. Okay. So as Allison kind of said in the beginning, expenses that impact your benefits, it was food, but thank goodness somebody got smart and said, no, food won't do it, but still shelter. So if your child is living in your house and not paying fair market value for living with you, there's a potential that they could impact the Social Security benefits, that they could reduce the benefit by 1/3. Go ahead. Sorry, that it could reduce the benefits. So again, we have to be careful of where we have this money, if it's in the trust, if it's in the ABLE account. There's so many things that have to be considered. Let's see.
A few questions about like when do I need to file a tax return for said kid? You know, like people have questions. If the kid is under guardianship, are they on my return or should they have their own return? If the child is only getting SSI benefits, are they going to be taxed? Do they need file a return at all? If the only money they've got coming in is SSI, can you answer a few of those questions?
Yes. So for example, my son is getting Social Security benefits. That's the only thing that he is receiving. So we will not be filing a return for him. If your child is working and they are receiving pay from a W-2 type position that they're doing, he or she will need to file a return if they receive more than the standard deduction, so 14,600, or if they have withholdings. I see it all the time with my regular kiddos too, right? They go out and they get a summertime job, the employer withholds money. I'm filing probably 20 tax returns a year for just normal children just to get back their $20 withholding, because $20 to them is worth filing a return. That kind of leads into, well, if they're filing their own return, they're no longer my dependent. That's not necessarily true. And we'll hit this in a couple of slides, but your special needs child can still be your dependent, even though they're above, say, 24 years old. It just depends on the facts and circumstances of where they are.
Kelly, I think we have entire presentations on the ABLE account. And so in favor of getting through the slides and answer more questions, we'll continue on and just invite everybody to go to the YouTube channel and check out the ABLE account. If you've got questions, we always offer free personalized consultations. Happy to talk to you individually about your ABLE account needs. But if you don't have an ABLE account, I guess what I would say, I am in favor of an ABLE account. They do have a Medicaid payback. If your child's not getting SSI or has Medicaid, if they don't have either one of those, I think it's totally cool to wait to get the ABLE account. There's no rush to run out there and get it right away. But it works beautifully with SSI and Medicaid.
Okay. No, yeah. So minimizing the tax exposure on a third-party special needs trust. So what you guys want to do is you want to work with whoever has your investments. You guys can pull most accounts these days. When you log in, they have a report called unrealized capital gains or loss. It'll give you your year-to-date income for interest. It'll give you dividends, capital gains. You'll want to run those reports periodically throughout the year, understanding that a lot of things pay out in the fourth quarter, especially if you have dividends, because you need to be aware of where your child is sitting or where that third-party trust is sitting in terms of income. If that third-party trust is receiving RMDs, so required minimum distributions, from someone that left them a tax-deferred account. So for example, a tax-deferred 401k, the special needs trust was the beneficiary, an IRA where the special needs trust was the beneficiary, getting the money out of those types of accounts, because those monies were tax deferred during the lifetime of the person who passed. The special needs trust is going to receive those monies on a payout schedule, and Secure Act 2.0 kind of Secure Act 2.0 did away with this, what they called a stretch. Now I think we have 10 years to get that money out of there. So every time that your IRA or 401k pays their required distribution to the trust, that's going to be income to the trust that we need to be aware of.
Kelly, I just wanted to talk about the stretch because they updated the 2.0 on the lifetime stretch. And they do offer a lifetime stretch for the individual with a disability, but there are some very specific rules and things that you have to follow, and you have to notify and prove that the person has a disability by October 31st, following a year of death of who, provided the money. So there's some rules for that, but they did extend it to a lifetime stretch, which from a qualified money, and we're talking about 401ks, 403bs, pensions, IRAs, those all have those required minimum distributions, but it is different and it did get better. When we first launched that 2.0, it wasn't very clear. It was unclear. It was like legal jargon that could be interpreted many different ways by many different professionals, but they did clear that up. But just know, and that there may be some directive that you want to put in your documents so somebody knows that notification has to happen by October 31st following that year of death, because if you miss that window, you're going to have issues with that. So I think it's really important that we'll know that.
Thank you, Allison. I know that last year they finally finalized some rules on the 2.0 for some other things that we were working on. The IRS. So let's talk about, as parents, what do we get? So on our 1040, our individual tax return, what can we get? Because our kids have a lot of needs. So for us as parents, we can take disability related deductions on Schedule A. Now, right now, a single person has a $15,000 standard deduction. A married couple has like a $30,000 standard deduction. So what we're talking about on Schedule A is where we go in and we itemize deductions to see if we can get over the standard. So keeping in mind that a married couple has a standard deduction of $30,000, can you, when you look at your charitable donations, the interest on your home, and property taxes that are capped at 10,000, can we add medical to that to get over the $30,000 standard? And I will tell you that in my tax practice, I don't have a lot of people that can do that. The only people that are doing that are my older clients that are paying for assisted living. So it's possible with our kiddos, if they're in a more care-driven environment, that we can get above that. But for most of our kiddos living at home and we're just coming out of pocket for co-pays and stuff like that, we may not be able to get above the standard.
I think it's most years you're not going to be able to get above the standard. Where I've seen families to be able to get above the standard, they're doing some type of treatment. Maybe they're doing a hyperbaric treatment, or they're doing some kind of treatment that is expensive. And it's out of pocket expenses. It's not covered their medical insurance. That's where I've seen people get over the hump on this.
That's what we're seeing too. But if our child is still a dependent on our tax return, if they are over the age of 17, we can still potentially get a child tax credit of $500. So that's a little bit different than the old days when we had exemptions. And so right now, children 18 and older are getting a $500 credit until they're off the return. There's no additional credit because they're disabled. There's no additional credit because they're special needs. We can, though, get a $600 credit for day camps and summer camps for those guys.
For a family that has an adult disabled child and they're paying more than 50% of that said child's expenses, then they can deduct that child on their tax return. Is that the rule of over 50%? Or is that what the rule is?
Yes. So the child, you need to be paying more than 50% of their support. And there is a link in the slides that will take you to a worksheet from the IRS to help us determine what is 50% of support. But the support, it looks at basically the household, divides the household by the number of people in the household, and then you determine if you're paying more than 50% of their support. Paying more than 50% of their support while they live with you or while they are away on a temporary absence. So if our kiddo is in college, that's considered a temporary absence because he or she will return to the home after they graduate. If they're in a facility, that can also be considered a temporary absence. But those children would still potentially be our dependent to qualify for the $500 credit.
So, and you hit exactly what I wanted you to hit on. If they were like in a residential living situation, let's say they lived at Margaret Brookwood or something along those lines, they live there and the parents are paying 100% of those expenses, then they would still be dependent on the parents' tax return, regardless if they're under guardianship, regardless of all of those things, because the parent is paying their expenses. Is that correct?
Correct, because they're disabled. Yes.
Got it.
Yep.
Thank you.
Um, so yes, they can live outside of the home. Their gross income, now gross income at $5,200, we're not counting things like social security benefits. We're not counting a lot of things. We're talking 5,200 is like my 20-year-old that doesn't live at home, that's working full time. I can't get him because he's making more than $5,200 a year at whatever he's doing. Let's see. And then of course they can't be married. So the last thing I think that we're hitting on is, and Allison had talked about it earlier, if you want to make gifts, you guys make them to an ABLE account. Those are easy to do. You don't have to worry about reporting those. Typically in the general world, you can make gifts to someone of $19,000 a year and not have to report that. So I can make a gift of 19,000 to my older son. My husband can make a gift to my older son. He can get 38,000. We're not reporting anything. But if you're making gifts to a third-party special needs trust, you do have to report that gift because the gift is not what the IRS considers complete. So we suggest when you can to make the gift to the ABLE account.
I just wanted to make sure that one little rule that is a little different, you know, how like multiple people can make multiple gifts, as you were just mentioning, that isn't true for the ABLE account because an individual with a disability can only have one ABLE account and the limit is $19,000 per year. Unless it goes a little bit higher if the individual is working and can put additional money in, but it's not 19,000 per donor, where it is on some of the other gifts, because that question comes up a lot. They can only have one ABLE account, which is a little bit different, where like a husband and wife could each have 529C for college for the said same beneficiary. It's not the same for an ABLE account. Only one ABLE account, $19,000 a year is the number, and it's not per donor, it's total. And anyone can contribute to an ABLE account. I could contribute to your kid's ABLE account, right? So the kid, it could be their earnings, it could be money that they got as the gift. A parent could put money into the ABLE account, grandma, grandpa, anybody could put money into that. So I just wanted to mention those differences.
Thank you, Allison. Let's see, on the next slide. Okay, so wrapping up, obviously planning is necessary, working with an attorney, working with someone like Allison, working with someone like myself. And guys, not having three of those people in a different room. You want to have three of those people together, coordinating with each other, because you're going to hear something from me and then you're going to relay it to Allison and it's going to get twisted up in the relay, how it gets relayed. Just have us all together when you can. It just makes the most efficient use of our time, makes the most efficient use of your time. So attorneys, financial planners, CPAs, we just work with that group and you're going to get the best results for everything. And then this, if you guys want to contact me, I'm happy to answer as many things as I can. Email this time of year, just because it's tax time, is best for me. But if you email me questions, I will definitely try to reach back out, coordinate a time with you, and so we can talk through some of your specific situations.
Who's going to get a copy of today's slides, and it'll have her contact information and a link to the recording. We've got a few minutes left. So what we're going to do, that was what I was supposed to do there. So what we're going to do is we're going to run through some of the questions right now. And we're going to do like speed run on some of the questions. An adult child support for special needs when parents are divorced. How do we protect SSI? That has to go to a first party special needs trust. So you'll have to work with an attorney to set it up with a first party special needs trust and a estate planning attorney. You'll need a child support modification attorney, a divorce attorney. Unfortunately, you're going to need two attorneys, but that's how you do it. And if you don't have child support post age 18, going to a first party special needs trust, there will be a reduction to SSI. And so then we have, let's see, an adult child with a disability on SSI living with parent listed as a deduction. We already hit about that. Um, are there any specific tax credits or deductions that parents of special needs, we hit on those, the 500 and six, what kind of the 500 and the 600 on your slides. Um, Autumn SSI, FAFSA tax requirements. This is kind of a, let's see, medical debt due to, I think this is a one-off, sorry. Can the special needs trust be a beneficiary for bank accounts, investments, IRAs, Roth IRAs? Yes, hallelujah, amen. Yes, they can and they should, and we should never, ever name our disabled adult child directly as a beneficiary. You want to name the special needs trust, so thank you for putting that out there. Can you put special needs dividends into a first party trust and of course put the dividend on the special needs individual's income tax? What is your thought on that?
Well, I think so special needs trust would have corpus that created dividends, and then the dividend would be an income, would be distributed to the individual if there were expenses paid out. So I think the answer is yes. I think the question just might be worded a little bit different.
Okay, does a person with a disability have to file a tax return, has disabled adult child social security of 1,700 per month, is on an HCS waiver for housing? So basically, if their only income is SSI or SSDI, they don't have to file a return, is that right?
Correct. They don't necessarily have to file a return. Some people want to just to get it on the system, but you don't have to.
We already talked about the rent that you charge young adults and whether it has to be on a return. How is tax related matters done when they're getting SSI military help through the parent? So basically, if a kid is getting a military pension, we already know SSI and SSDI don't have to file a tax return. They don't have any other income coming in. If they're getting military pension benefits, do they have to file a tax return?
Military pensions are a little bit special. I would have to talk to them individually so we can talk through it.
Okay, and then when on a Medicaid waiver, my understanding is if a parent is getting paid as as a caregiver under a Medicaid waiver, that they do not have to file income tax on that money. Is that your understanding as well?
That is my understanding. So for some reason, if you receive a W-2, I think that was a question about PALCO, connect with them because it has to do with how you filled out your paperwork.
Okay. Okay, and this, what I would say is probably more of an attorney question. Is it possible to get a pool paid for as a medical necessity out of a special needs trust? And my experience is ask an attorney, and you might want to ask multiple attorneys, and it depends on the trustee and it depends on the wording of your trust. So that is a very loaded question. And in general, unless it can really be proven that it's really for the best interest of the kid and it's going to improve their functioning as an individual, then I've historically heard no. But I think that it could be a one-off on that. So again, that's not a slam dunk. Okay, so we talked about a kid moving to their own apartment, starting part-time work, but if the parent is basically paying more than 50% of their living expenses, then the parent can still claim them on the tax return, but he's doing part-time work. So what is the number that the kid can earn and the parents can still claim them on the tax return? If they earn over a certain amount, then they'd have to be on their own, or how does that work?
Yeah, so I think with this child, I would probably put him on his own because it's 5,200. It appears that because he's living on his own, even though mom and dad are helping support, this child, I would say, would be on his own. But again, keep in mind, we're only losing a $500 credit. It's not detrimental at $500.
Okay, a lot of our questions are the same ones. The qualifying expenses of a trust and an able account, we kind of hit the highlights that basically on an able account, if it can be construed as achieving a better life for an individual with a disability, you can pay for it out of an able account. You can pay for food and shelter. Food doesn't matter anymore, but shelter out of an able account without a 1/3 reduction. many things can be paid similar to if it can be construed as achieving a better life, really, for an individual with a disability. You can pay for it out of a special needs trust, but we don't pay money directly to the individual, where an ABLE account can pay money to the individual and it not count against them for SSI purposes. We would pay for things for the benefit of said person. So those are some of the differences. And I know we have a form of what a special needs trust and what an ABLE account can pay for. There is confusion on that. All right, we're out of time for today. We're gonna take two more questions and you're gonna pick them, Shelli, out of the chat box. And any questions that we didn't get to, we'll get back with you guys on. We're just out of time for today.
Yeah, I will definitely get back. So let's see, there's so many. Sorry, you guys. Um, did I understand that? No, we already answered that one. ABLE account is, let me see, sorry. Child support, we've already addressed. I don't know, we might, you know what, there's so many and some of them are long. I don't know that there's two good ones.
Can make a deposit from the first party to an ABLE account. A special needs trust can make a distribution to the ABLE account. So we will put a PDF of today's questions out there. Everybody's going to get a copy of today's slides and a link to the recording. So we will reach out for the additional questions that we didn't get to. You guys have asked awesome questions today. So thank you for taking your time to be with us here today. Thank you, Shelli. Thank you, Mike and Blake. From the Misty Carroll Project. It's been great. Lots of great questions today, and we'll look forward to connecting with everybody again soon. You're going to get the contact for Shelli. You can reach out to her directly and kind of go deeper with her on her services. You'll have our contact information as well. Thank you everyone for joining us today. Certainly been our pleasure, and I hope you guys will have a great week. Take care.
Thank you so much.
Bye now.